I'm Sarah Borkson-Keto here in Los Angeles for REITworld 2019, NAREIT's annual conference. I'm joined today by Cedrik Lachance, Director of REIT Research at Green Street Advisors. Welcome, Cedrik.
Thank you. Happy to be here.
So, Cedrik, Green Street has done a lot of work on property sector allocation in recent years. What are some of the key recent conclusions that you've come to?
So sector allocation is very important. I think a lot of investors have realized that the sector decision is at least as important as the securities decision that they're making. As a result, we've invested a lot of resources in identifying the key drivers of performance at the sector level. And for us, there are two things that really stand out. The cost of maintaining building to a competitive level, so what's known as CapEx, of course, and what cash flow can be generated over time from those buildings. So what's the long-term NOI growth of the assets? And there's no question in our mind that the low CapEx buildings or the low CapEx property sectors tend to provide much better performance over time. It's true historically, and we think it's going to be true over the long term as well. What we really believe, of course, is the combination of the two, the CapEx and the long-term NOI growth rate, that can identify sectors that can perform better. Some of those are niche property sectors, but you might be also surprised to find sectors like industrial that have a reasonable CapEx level and some interesting long-term NOI growth rate as well.
So Green Street recently changed its pricing model to arrive at REIT investment decisions. Why change the NAV-based model that had been used for decades, and can you describe the key changes that have occurred?
Yeah, this is an important change at Green Street this year. It's one that demonstrates also how we invest continuously in our REIT research effort. So it's not the first time that we changed our pricing model. We made some cosmetic renovations, if you will, in 2005 and then in 2013. But this time you can think of it more as a full redevelopment of the model. When you think about the pricing model, there's really two elements to it. There's what's the value of the real estate that's owned by a REIT, and how much more or less than the value of that real estate would I pay based on the franchise value, the balance sheet, the G&A of that company. So basically the corporation, what would we pay for that? The starting point is where we've made the big change. We used to take our NAV values, of course, from the private market. So we would identify what the cap rates are in a particular market and use those cap rates in our NAVs. So it would be a private market NAV that we would derive. Where we've gone to is a Green Street derived value for the properties. And we've decided to do that because we've built so many tools over the years with our real estate analytics effort, all our private market research, that's really allowed us to arrive at what we think the real estate should be worth. That change is meaningful, and we think is very positive to how we're going to determine more of the share prices and pick stocks over time. So that's the first part of the change, deciding to use Green Street, what would Green Street pay for the properties rather than a private market value. The second piece has been to make these premium discount to the value of the real estate a little bit more transparent. So how we determine franchise value and how that impacts the value of a company is something that is now done in a way that is a lot more visible to our client base, and therefore a lot easier, I think, to understand. The results have been very good. So far this year, as we've been using the model a lot in the background, we're having one of our best stock picking years.
So as Global Head of REIT Research at Green Street, what are some of the key investment themes that you're looking at outside of the US?
What's really interesting to us is how a lot of the themes are similar, but how they evolve differently and how the pricing reacts differently in different geographies. So when we look at the impact of e-commerce, flexible office, socialism, all of these big drivers of changes to the real estate values are not getting priced as quickly, or sometimes getting priced a lot faster in certain geographies. One that's really interesting to me is the positive disruption that we're seeing with e-commerce. So basically the industrial demand that's being created via e-commerce is being priced quite fairly in the United States. It's been identified, it has resulted in a lot of growth and demand, and the pricing has been reflecting the positive expectations of people. By contrast, in Europe, we see industrial as being still very attractively priced, and it is so simply because we think that there's a lot longer runway for growth in e-commerce demand that is going to create that additional demand for industrial, yet it is not priced in a way that you see in the United States.
Great. Cedrik, thank you so much for joining us today.
Thank you.
And for more on REITworld 2019, be sure to visit REIT.com.